Hit it.
It's Friday, January 23rd, 2026, episode 283. I'm Patrick Serezno. Now, Kevin needed a day off, but before he did, he recorded a great interview with Alex Gurevich, author of The Next Perfect Trade. They discussed Alex's 10 years of lessons, poker game theory, and why he thinks rates may go down to 0%. And in Kevin's absence, we invited Chase Taylor to join me to smash through some charts.
So, Pat, what are you drinking today, bud?
All right. Well, listen, I found this really cool Ukrainian shop selling some great different goods from Ukraine, and they were selling the White Lion wheat beer, and it's all written in Ukrainian alphabet. So I don't know exactly how to read all the details, but I'm going to give this a try, and maybe I'll go back for some more if
Nice.
I'm enjoying it.
Nice.
Listen, give us a disclaimer, buddy.
I'll try my best. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include Davos delusion disorder, taco trade Tourette syndrome,
Ooh.
dollar breakdown derealization, and the precious metals parabola panic.
Ooh, that's all true. That's definitely suffering from all of those. All right, let's get to Kevin's interview.
Hey folks, Kevin Muir here, and I'm pleased to be joined by Alex Gurevich, author of The Trades of March 2020 and the upcoming second edition of The Next Perfect Trade, A Magic Sword of Necessity, which is available Tuesday, January 27th. You're going to be hearing this before. It's very important you don't go buy it before because that's the first edition. Second edition is much different, and do not buy it until Tuesday, January 27th when the second edition comes. Alex, thanks for coming back on the show.
Thank you. I'm very excited to be back.
All right. So, so you have this new book. We'll talk about, actually, let's just start with the book. What prompted you to write this new version? There we go. I was fortunate enough to read it, and I loved hearing all the different kind of, a decade later wisdom that you had. Was that kind of the impetus for doing this? Is that kind of it felt very much to me like George Soros when he did his book where he had a real-time journal of his trades. It felt very much the same way to me, this current book.
It is interesting that somebody recently just made the exact same comparison with George Soros. But so it's a definitely great minds think alike. So I feel it's like when people don't read strategy books, like when I originally wrote The Next Perfect Trade, it was just basically capturing what I've experienced up to that point and the strategies that worked for me up to that point. I was talking about things that happened in 99, 2002, 2007, 2000, all of 2014, right? And clearly by just survivorship bias, as I was sitting in that seat in 2015, they must have worked for me. And then I'm laying out a set of, right? Because otherwise nobody would buy my book, right? Nobody would care if I always losing money, right? So clearly it somehow worked, or at least more often than not.
Right. And for those who don't know Alex's background, I encourage you to go and listen to our January 2022 interview on The Huddle where he came on in with his second book. I'll just read this little blurb here from the Amazon. After earning a PhD in mathematics from the University of Chicago, Alex leveraged his passion for trading, for strategic gaming into a lucrative Wall Street career. He's been hailed by the Wall Street Journal as the star trader of JP Morgan, where he served as managing director in charge of global macro trading. And in 2020 was leading Hontes, am I saying that right? Hontes? Macro trading strategy, where he ranked second by net return, according to Barclay Hedge. Alex is the best selling author of the book, so we know. So those are you're very much a quant. You trade a lot of fixed income, but it's not just fixed income. And I guess let's get to this because you said something interesting to me that I know a lot of people will be chomping at the bit to hear more about. You said that we've moved from gold to silver, and now you have a new metal that you like better. Can you tell me what your framework is when you're thinking about precious metals and your investment opportunities right now?
Okay, yeah, let's talk about precious metals, but I want to also feed it in what we were just talking before about the second edition, because as I mentioned, because I want to see how, like, I want to think about how my strategic principles apply to precious metal trading. So as I
Okay.
said in my first book, I outlined this set of strategic principles, right? But they were backward looking. That was what was working over long periods of time in the past relative to 2015. Now, the question any reader should have asked back then, is it going to work in the future? And now the reason I'm doing the second edition, that I want to look back at this last 10 years and see how has it worked. That's why I did not really change very much, except for a little bit of like cleaning up the language of my first book. I want to say, here you say all the things I was saying back then, and then add the comments how it has worked out. So
Okay.
if there is a forward forecasting power to what I was saying, but also to evaluate my psychological and intellectual discipline of following my own principles. Because if you
Right.
read the second editions, you will see the points where I veered, where I failed, or at least was not perfect, and where I succeeded. I'm not saying it was all a failure. There were some great successes, but there were also some doozies there. So over the last 10 years. And the 10-year horizon is really interesting because this is how long the precious metal cycles are. They operate not on 3-4 year cycles. There is a reason why we're there. 10-year cycle for precious metals. If you the last big peak in gold was in 2011, and then it was sitting basically not doing anything for a really long time, and then it started to really move in 2020s. And the gold moved, and the gold move was for like forever, like for years we were saying, I remember they're laughing, gold is trading with 1100 candle or 1200 candle. If gold goes 1800, that's like crazy price sell there, right? It was just really in a very narrow corridor, and platinum was stuck at like $900 or $1,000 an ounce forever.
Right.
Then suddenly gold started to go, and over the recent years it quadrupled, and silver for a while was a laggard. And everybody's like, what happened? Silver gold ratio at all-time highs. And suddenly, guess what? Silver started to move and totally outshined gold, so to say. And people are, for the second time in history, an ounce of silver is worth more than a barrel of oil.
Oh, wow. I didn't realize that.
Last time that was happening, it was on 79. But right now, it's worth a lot more than a barrel of oil, right? Like 95 versus like 60, right? So it's a pretty big difference, right? So but historically it's a very different ratio, right? So silver made a big move and platinum was lagging. But in order to really clock those moves, you need to be able to think of decade-long investments, which very few people have patience for. And a lot of people say like, well, I don't have capital or ability to wait like 5, 6, 7 years for my trade to work. What I always say, it doesn't matter whether you trade for 1 second or for 5 years. The important question, are you getting good return on capital? Now, from my perspective, quadrupling your money on silver and gold is a good return on capital. Even if you had to wait a decade for that. I mean, even if you're not a leverage trader, it's still a good return on capital.
Right.
I mean, people sometimes compare S&P to gold returns, and it's a little off because gold has storage costs and S&P has dividends, so it's not quite exactly the same. But the point is that it has been worth being in stock market, it has been worth being in precious metals, it has been worth being in cryptocurrencies. All those things have done well over the last decade. So it's better than not being invested, let's put it like that. So
and now you've said we've gone from gold, and then now we've had silver, and so you mentioned platinum. What do you think about its chances going forward?
Well, I think platinum is just waking up.
Okay.
I'm not saying that it's very early stage, because platinum did rally % from the lows, but I just think that there is more that rotation. Palladium rotation is a little more tricky. I cannot right now have strong opinion on palladium, though I use palladium very closely and I used to trade it.
Okay.
I mean, I was the one pounding my fist on the table when palladium was $200 an ounce in 2003.
And why do you think that we've had this? Why do you think platinum? Why do you think we go through these periods where no one cares? Like, it's interesting because silver, like you hit upon that, is that it was quiet even as gold was taking off. And I said to everyone, well, central banks don't buy silver, they buy gold. And that was to me why it was. But I'd be curious why you think silver was lagging, and then what changed.
I have a confession. It's a complete mystery to me why precious metals actually move. Because people make all those stories about um, central banks buying, speculative bubbles, liquidity hedging. Some people say people buy it to hedge inflation. Some people say people buy it to hedge deflation.
Right.
That's just they just give you the realm of how big is the range. Some people think that there is this popular conspiracy theory that banks somehow try to suppress the price of silver.
Oh yeah.
I mean, I just like look. I was on the currencies and commodity. I was on the management committee of currencies and commodities group at JP Morgan. If somebody was
Yeah.
trying to suppress the price of silver, I probably would have heard about it. Somehow they pulled this all around me and I never heard a word about it. And why and for what reason, I just really have no idea, but there is always like floating rumors about people.
Yeah.
So I'm not really a chartist, right? I like to
Yeah.
think in things in terms of like, if you read my book, it's not all about charts. It talks about trends, but mostly I look at things like carry, valuation pool, kind of dominance in terms of trades that work in a wide range of economic scenarios. I look the correlation of global growth and economic development and just historical patterns. But if you look in a very broad sense, precious metals, they're almost like easier to think of in terms of charts. You just have to look at very long-term charts.
Right.
You just look at where they went last time in this situation. And if you look at the previous spikes, like I kind of set myself 50 to 60 silver price target many years ago. And of course, retroactively, it was very conservative. I should have set it higher.
Right.
My gold price was only set at 3,000. Again, I was very conservative, but I should have set it higher, right? So I'm, of course, like, I don't know, like it's being conservative, like you don't get fired for being conservative on price targets, but it's good to keep your trades run. So I'm trying to have my good trades run, even though sometimes I take profits too early. But looking at the charts, you can kind of set minimum price targets for the next cycle, and you can estimate the duration of the cycle. And I think that's like really, when I started to look at cryptocurrencies, for example, it's not because I had any idea about the technology or math behind them, is because I started to see the patterns of trading, which are similar to precious metals rotation. And then I saw like, oh, well, if I can trade precious metals, maybe I can trade digital currencies as well. I mean, the point is to buy low and sell high, right?
So one of the things that I always liked about you, Alex, is that you were very insistent on people not putting charts on Twitter that were not total return charts. Like all this crap where you'd see people would go like, I bought VIX, and they don't realize that in the meantime, they claim that they were long, but they weren't using an actual properly rolled VIX, and the carry was huge. And one of the parts of your book is it's called Swim with the Tide. And I love that. And I think it's a great kind of moniker for what you should do. And you say, avoid trades that are expected to lose money if held for the long term, no matter how compelling the shorter term arguments for those trades are. And then you said, first catchy trade phrases like don't trade against the trend are not automatically universal truths. I prefer don't trade against the trend in a market which appeared to be trending. Talk to us a little bit about positive carry and the problems you see with people buying assets that are kind of have let's just say a mathematical edge for them losing. And that's kind of how I think about it. Like if you own VIX for long enough, you're going to lose. And there's all sorts of trades like that. So I would love your kind of, expand on that. Talk to us about what you talk about in the book about swimming with the tide.
Yeah, I like to think of it one other way. You actually summarized you gave some very good quotes from my book, and that's the book that is getting re-released. And I like to think of it a lot in terms of like all else being equal principle. Imagine that I don't know anything about an asset, except the fact that it earns 2% carry. That is, the funding costs less than the profit I'm getting on an asset. Well, then I'm more likely to buy if I don't know anything about an asset which has negative 2% carry.
Right.
Like that is just that. There have been some studies, for example, on foreign currency performance, like if you sell one currency and buy another currency,
yeah,
it's like one of the best predictors of long-term performance of a currency trade is just nominal. Whichever one yields higher,
Yeah.
you should want to hold, and whichever one yields low, you want to borrow in. Because the speculative aspects of this, when you try to like kind of get speculative edge, and people try to get them based on market positioning, seasonality, flows, sentiment, it's so fickle and so hard to pin that I tend to not even try.
Oh, I see. So you're just like, I'm not even going to try playing that game. I'm just going to look at something that carries positively and assume I can hold this for the longer term, and that's my edge.
Well, I look, yeah, but I want to not just look at carry. For example, gold and silver call carry negatively.
Right. Fair enough.
So there could be other, like, but then the trend is strong. And as I mentioned, like certain markets, you can recognize the trend and roll with the trend. Or you look at valuation too. Is it like cheap right now and likely to get more expensive? But if the asset is expensive and carries, what I tend to do, I tend to maybe like get out of trends when I feel that the asset is too expensive and has negative carry.
Right.
But also like I want to see like, okay, what is happening? Is the world helping this asset or hurting this asset? Like, for example, copper electrification is positive tailwind for copper, right? Even if it has negative carry, but there is a tailwind for copper prices globally. It's not surprising that copper has been doing well. It's not surprising that, for example, if there was a technological shift in Europe, that they're gonna not switch to EVs as quickly as they thought, that it's a tailwind for platinum. Incremental one, but it's a tailwind for platinum. So you look at global growth and technology development, you look at those factors which are kind of as objective as possible, as incontroversial and possible, and try to kind of forget about speculative factors as much as I can, not always fully.
Right.
And just kind of assume that I don't know anything. Assume that I'm an alien coming to Earth and I'm trying to buy an asset. And I'm like looking, okay, which asset is historically cheap? Which asset carries positively?
I got it. Because it just, that tailwind really makes a difference. One of the things that you, that we were chatting with about before we started is that you have historically been a big bond bull, a big bond bull. And one of the charts that you always showed that people mistakenly didn't look at is the positive carry that we have when the front end of the curve is lower than the long end of the curve. And I used to be at a bank, and I remember going, and I was the equity derivatives guy. And I also had the same sort of positive carry. Like the reality is that we funded in the overnight, and the reality was that the curve was upwardly sloping. And so as long as the Fed, or for in our case, the Bank of Canada, didn't raise too much, we would win. So we would always be long that carry, right? That we would be borrowing at the short end. And I was always shocked when I would go talk to the bond guys. They were always long. And I was like, Jesus, you guys are always long. And I realized the reason they're always long was the curve was normal shape. And that therefore they were picking up carry every night as long as it didn't go down. But one of the things that you said earlier to me before we started was that you are back on the bond bull side, or not even the bond bull side, the front end of the curve. You have a very bold prediction, and you think that we are this era of higher rates is an anomaly, I guess. And you think we're going back to lower rates, and you actually used the zero word, which I haven't heard in a while. So tell me about that.
Yeah, let's talk about that. But I want to do it with a caveat. You pinned me correctly that I tend to be a bond bull.
Yeah.
And in my book, in The Next Perfect Trade, I have the chart, which I call the one chart, which was the chart of bond futures, that they were like in a perfect trading corridor for decades. Yeah. Now, one of the notes I made from 2025 is where I went wrong in the last few years.
Yes.
And one of the theses I had for a long time, and long before this trade, not before the volatility of 2020, I always said that the steady bull markets, like very steady long-term bull markets, they never break down, they break up first.
Okay.
So first they go vertical up, and then they can crash. They never like go in straight line and then suddenly go down. Usually this very steady thing, because this very steady thing, eventually it convinces people that there is no risk in the trade. They'll go long, get into the bubble, go straight up, and then there's a crash.
Fair enough.
So bond classical bond futures on a total return basis were in the trading corridor for decades. They broke this corridor. They broke this trading channel on the upside in 2020 in the middle of
Okay.
COVID crisis. And I did not take my own cue and understood that now they're going to break this channel.
and I have to give you kudos
very
because
much
you're very honest about that error that you made in staying long fixed income too much in the 2021/2022 bear market, and you're quite honest about it in the second edition of highlighting that was a problem.
Yeah, so that is, well, I guess we all have to learn some things.
Yeah.
And again, as I said, it was not all bad. I made some too, but
all right.
This was an error. And the worst, in some sense, it's the worst error when you don't listen to your own wisdom. Like,
doesn't that feel worse?
Right?
Yeah. There were so many times in this book that I was reading it, and I was like thinking about my tagline that I say, all I bring to the party is 25 years of mistakes, although I have to change it to 35 years, because you do make mistakes and you hope to make new ones. But I find that even after this many years, Alex, I'm still making some of the same mistakes. And I'm like, I know better than that. Like the famous Stanley Druckenmiller line where they asked him after the .com bubble, they said, what did you learn from that? He goes, and he says, absolutely nothing, because I knew it was the wrong thing when I was doing it, but I couldn't stop myself.
So you know what? All we have to hope for is just be right a little more often than wrong.
All right, so let's talk about. Let's go back to. You have a feeling that we're going back to zero, which I was quite shocked when I heard you say. Why do you feel that way?
So again, the caveat: I felt that way for a while, and it's been definitely not happening on my schedule, but I think it is beginning to happen. So my original thesis had nothing to do with AI. Even though I did know the AI timeline. The AI timeline did not surprise me. I've been following the timeline for a while. I thought it would be like a little slower, but for people who follow Singularity, everything is proceeding exactly to the Ray Kurzweilian Singularity plan. So that we should have expected all this LLM stuff. It still came a little bit as a surprise. So that's not what I was thinking about. But what I did see is I did see the big inflation whipsaw. I saw in 2021 and 2022, inflation go high, rates were low, real rates went to like -9%. In retrospect, I should not have been surprised that inflation was persistent and pernicious, because in the environment of -9% real rates, like the money creation will just keep going like crazy, because people have incentive to borrow if they borrow at -9%.
Right.
So money will just being created, right? So that just kept it didn't matter that inflation, original inflation, post-COVID inflation impulse was transitory. It was there anyway, and it created less transitory inflation. But then what we saw is inflation coming down and getting somewhere into the normal area. We saw rates go way up, rates go back into the positive real rates scenario. And typically when real rates go positive, it incentivizes people to contract balance sheets, and that leads to labor losses. And guess what? We're beginning to see labor losses. Right. Slowly, maybe not on the schedule I thought. I will be the first one to admit, but we're beginning to see gradual deterioration in the labor market. But now this AI arrived.
Okay.
Not completely out of left field, but it arrived, right? And we're beginning, and it's possibly, I'm still saying possibly, accelerating labor losses. And I just really don't see this thing not spiraling. Meanwhile, the headline inflation is definitely not going up. It's just kind of stabilized, but that's almost not important whether it's 2% or 3%. If we're heading into massive spiraling unemployment market, if we're looking at the whole categories of labor beginning to disappear, and this is all with a background, hasn't even started yet. I think actually, honestly, the impact of AI so far was minimal. We're just beginning to guess it in terms of labor losses. Because so far, as it takes as many people to implement AI as the jobs it eliminates, right? But it's definitely happening, and productivity growth will definitely be really strong. And I don't even know if it's so positive to GDP, because certain areas of economic activity are just getting eliminated. Like what I give as an example always, like going to a lawyer and getting some document drawn, which would cost $500. Now you just a ChatGPT draw this form in, or whatever, Grok or whoever you like, or going to a doctor for second opinion. People now go to second opinion to LLMs, right? It's just like, it's that much less economic activity is happening. And so and at the same time, there is people are reluctant to hire because they now, people who do startups no longer need like patent lawyers. They no longer need accountants. They do a lot of things, bookkeepers. A lot of stuff is being replaced by LLMs. It is still on the margins. And meanwhile, we have positive real rates. And the positive real rates incentivize contraction of balance sheets. So what I think is going to happen is, I don't know what's going to happen to stock market, but the history shows that sooner or later stock market goes down. It just goes up till it goes down. And just when I see no reason for stock market to go down, by the way. I see absolutely zero scenario in which stock market can go down. And therefore, I think it will go down because
you're like George Costanza, where he does the contra. So he says that everything I know is being wrong, so I got to do the opposite. And then he goes and talks to the girl. He says, "Hi, I'm a balding middle-aged man who lives with my parents. You want to go on a date with me?" So that one of the things one of the things that I'd love to kind of pick your brain about that I've been struggling with is I understand the argument that higher real rates will slow down the economy, and then inevitably that will result in lower front end rates. One of the problems have been during this last few years, I guess, ever since we've had the raise in rates, the curve, like especially at the front end, has been so inverted, meaning that they go out and they run ahead and they price in so many cuts all the time. So it ends up being very difficult to hold, 1 year SOFR futures because they're now carrying negatively. And you need the economy to roll over even more so. Do you have a theory on why this is? Do you feel that this is different, or is this just, standard for the course? And I was in a strange environment when the curve was upward sloping, and that was kind of the golden age of riding the curve, and I shouldn't expect that to come back.
Well, I think we're a pretty good place right now to ride the curve, by the way, because once you go 2 years out, you already get upward sloping curve. The curve is back to upward sloping. However, I will do a solid caveat. I do think this was unusual because in the past, even when the Fed priced the cuts and inverted short end of the yield curve, almost in every single situation, Fed didn't price enough cuts. Whenever they priced 50 basis points, 300 basis points would happen. So if you go back to 2001, 2002, to global financial crisis, to COVID crisis, they never quite able to price right away as aggressive as the cuts actually are going to be, because there is a certain mental resistance to really pricing what's going to happen. It's like they do intermittent cut and then they're not pricing 50 basis cut on the next meeting. While there is no precedent of Fed making intermittent cut and not cutting again at the next meeting, right? Of course they're gonna, if they have to cut intermittent, of course they're gonna do another cut. But market is just, I've talked about this in my second book, The Trades of March 2020, like a market reaction to COVID. There is a certain resistance. So I'll confess, I was programmed to always expect that, oh yeah, they're pricing 50 basis points cuts, right? It's going to be at zero. Now, this was a weird cycle because there was a strange resilience in the economy. Like there were many times when by the book economy had to go down.
Right.
We had like yield curve, very strong negative impulse from and I talk about this in the second edition because I had this like stock bond correlation that between like the change in momentum in interest rates is a very good predictor of momentum on the stock market, and it kind of broke down over the last few years because the interest rate momentum was very negative for the stock market, but stock market just kept going up, which hasn't been really the case since 90s that will happen. So so it is definitely a different situation, and you could attribute that to very high overhang of liquidity from 2020 to 2022. You can attribute it to capex from AI and other things, maintaining the final demand. There are various, you could just attributed generally to global fiscal dominance.
Right.
There are many factors that are changing the equation, and we definitely as traders have to adjust to the pace that, whenever market is just pricing a little bit of easing, you just want to get long and take those eases.
Yeah.
That was not working as well as it did in the past.
Right. And I have a quote from your book, actually, because I highlighted that part. You said, whenever the Fed is actively changing the rate policy, the market is reluctant to project moves into the future. The forward rate expectations will decouple from current policy. And then you said, so I told myself, never again will I underestimate the scope of possible shifts in the shape of the yield curve.
Right.
That's what you're talking about, is that it ended up being way more. Right. Yeah.
And I said, never again I will underestimate, but I think I still underestimated them. In the last few years, I have to confess, I didn't expect all the shifts of yield curves that occurred in 2020 to 22.
You crack me up. Okay, I'm going to pick your brain here. Let's talk a little bit about portfolio management, and specifically, and this kind of maybe will dovetail into the carry trade. And I'm just going to read you a part that I thought was very interesting from your book, and I'd love to pick your brain, see if your thoughts have changed about this. It's actually, you highlight one of the friends of the show, Jim Leitner. Before he went off to his other firm and can no longer appear on our show, he used to come on our show all the time. He's a good fellow and just a good friend, and I absolutely just a mensch of a human being. And I love Jim to death. But you talked about this. You said, at this point, it is important to stress that this is my individual preference rather than a universal trading principle. Recently, I've discussed this subject extensively with Jim Leitner of Falcon Management, a celebrated macro trader. He prefers to use options to express his strong, long horizon views. Jim is confident that out of the numerous option trades he will execute in his career, he will be right a large percentage of times. He doesn't mind losing on some of those trades as long as he makes a big score when he hits the jackpot. This is where it comes down to style. Jim wants to have a lot of leverage and sleep well at night. I, however, lose more sleep because of option decay when a trade refuses to move in my favor for a couple of years. I feel that perfect trades are such rare gems that I must capitalize on them with full patience and strategic commitment. If I miss one, I may miss another, and there goes my year. And then you go on to say, that is what Jim has said is given good food for thought. And so you speculate that this might be a good book to write. Has that changed? Do you still feel the same way? Do you have any kind of updates and what, just give us a little bit of color on using options?
Well, it is interesting that, yes, that has been a little bit of a shift, and I used options a little more in the last few years, as I mentioned in this new edition. And I would say that net using options more was a success. Using options was a great success in 2019 and 2020, which it was actually interesting because I recognized a very great misprice on deep out of the money euro-dollar options in 2019. And there was an interview I did, I think it was a Real Vision interview I did with talking with John Burbank about the use of he was running Passport at that time, and we discussed using this deep out of the money options in 2019, the trade that worked very well then, and then even better in 2020.
Okay.
And further, I had success using options, protecting because when I was long and wrong, in 2022, I used some options, and it saved me from portfolio from collapse, right? Because I was projecting what would happen, because when I was long, December 2022 contract, when it was at 99.25,
right?
I was long with via options, believe it or not, because I thought there would be no cuts in 2022. Instead, there was 400 basis points of cuts. And it worked so much better using options than being outright.
Oh, right. So there was an example of how you have changed.
However, since I've had use options, and with there were trades recently that I've used options, and the bad things happened exactly what I outlined in my first edition of the book. That you use options, you're kind of right, you kind of the trade kind of grinds and the options decay, and this is the worst case scenario. So I've experienced both the stellar use of options, both to capture outsized upside, arguably even better use of options to not blow up your portfolio, which is always a good thing. But I also use the worst case of options, which when your trade doesn't actually go against you so much as it like grinds to the strike.
Oh, that's the worst.
So
For
I've had
me,
all those experiences
yeah.
since.
So for me, I actually had a little bit of a come to Jesus moment in terms of doing this show, because I grew up like trading on an institutional equity derivative desk, and we traded short dated index options. And generally those all trade fat versus realized. And I had a bank's balance sheet, so I was always short. I was always short, and it was a great trade. And when it went against us, like in long-term capital management, we were just able to sell more and do better. And like, so it was great. And so I kind of was always a negative, gamma trader. And that's how I grew up. And then I did these interviews, and I would talk to people like Jim and Morris Sachs, and other people that were super successful, really, rich guys. And I realized that they use options a little differently than I had ever done. They use long-term options, and they don't hold them to expiry. They roll them way beforehand. So it's a completely different thing. So what I've found is that I love trading like 1 year options with all sorts of vega, and then and so the theta is very limited, and then I roll them at 6 months, and I use it that way. And I attribute like a lot of that that knowledge to Jim and to Morris and guys like that. So that's been my experience. Let's talk a little bit. I saw this one quote that I would love to pick your brain about. You said something to the effect that trading is more like duplicate bridge than poker. And I think a lot of people would find that kind of not what they'd expect. Can you explain what you meant?
Well, that what I mean by that is that you basically all dealt the same hand, right? You all come back, you all come to the morning, like how duplicate bridge dealt. You are being compared with your peers who were dealt the same hand and playing against the other counterparty, right? So every hedge fund manager wakes up on Wednesday morning, as is the case today, looks at their screens and decides, what am I going to do with this? Like Greenland, this, that happening, like commotion, are we fading it? Are we going with it, right? Now, what you're dealt is completely random. You cannot protect yourself against all the random events that happen in the world. Every time new crisis comes, you could be positioned for against it. So like whenever some exogenous event happens, event that you couldn't predict, it's 50-50 whether it's going to be favorable to your portfolio or not, right? It's a completely, by definitions, if you foresaw it, it would be different, but something you haven't foreseen is going to, by definition, be random to you, right? So you're faced with some random situation, and you have to make your decisions based on the situation. Are you going to play for hearts, or are you going to play 3-no Trump? That's kind of a duplicate bridge decision, and whoever makes a set of better decisions over a long period of time given the same market is gonna win. It's not about like outsmarting somebody else psychologically. It's not about like there is no one enemy here, right? You just try to extract money from the market. That's why I think it is a like duplicate bridge. We're all put on the same table. This table is random, but we're all in the same position. If I got bond market wrong in 2022 and somebody else got it right in 2022, there is nothing I can say. They just outplayed me on that hand.
Got it.
It doesn't mean that they're a better trader. It means that on that particular hand, they outplayed me. But maybe next hand, I'll outplay them.
Okay. Let's talk a little bit in the book. You mentioned, I guess, how should I word this? The importance or the benefit of having confidence. And like you talk about, it's easier to play when you're up. And things of that nature. Like, explain what you meant there, and what you're kind of where you're getting with that sort of analysis.
Yes, I find that like for traders, in this way, trading is very similar to poker. In fact, this is a strong similarity to poker between trading. So from years of playing poker, I've learned, eventually I've designed a strategy that if I sit down to play poker and after say 45 minutes of playing, things are not going well, I lost a couple of big hands, I'm not feeling I'm playing well, or on my left, which is a superior position, if people know poker, like the positioning stuff, personally gives me too much trouble, I just don't like this table, I don't like my play, I'm just going to get up and go. I will never go deep. And that took me years to develop this approach. I will never go deep and keep buying in if things are not going my way. But if things are going my way, I would play through the night. I would just go for it and try to build up, which is totally opposite what many people do. They try to take their winnings and recoup their losses. And the reason why I realized, first of all, I enjoy myself more when I'm up money. It is fun to play when you're up money. And if you have money and you lose a little bit, like say you're like the Income's portfolio, you're up 10% on the year and you have a down 1% day. You're not like really upset about this. But if you're down 5% on the year and you have down 1%, then you're like watching the screens, right? Because you're like, what I'm gonna write in my next investor letter? It's not gonna be pretty, right? So the moment you start being attached to the immediate outcome, it's like in poker being attached to the hand. You already know that this hand is not going well, but you're like, how can I use it? How can I win it? Maybe I can like bluff, or maybe I can like hope to draw like a card. Either of those paths, if the situation is not right for them, for the disaster. Same thing with trading is like when you feel like, oh, how can I make some back that I'm down this month? It's a wrong mentality. If you are if you up money on the year and you down a little bit, you're like something position moved against you, might even, oh, I can add to this position. Or you can say, you know what, I don't like the way it's trading, cut it out. You make those very easy, pleasurable, and reasonable decisions. While when you're down, especially if you're under external pressure, and that's I think very important for portfolio manager to make sure that they do not face too many external pressures. Like if you like if I lose another percent, my boss will fire me or my investors will pull the money out. There is very little chance that you will be the best trader you can be in this situation.
Got it. The other thing that I found fascinating about your book was the idea of that you, on the whole, don't use stops, or you don't use stops the way that most people use stops. And this part just rang so true to me because I use a portfolio stop as well. And I think that's something you talk about. Explain what you mean and why you've come to this conclusion, and, explain what kind of the benefits are to your approach.
Yes, I think that the main purpose of of risk management, rigorous risk management, is to prevent yourself from portfolio ruin. So no matter how good your trades are, if you're a leverage trader, your portfolio could possibly go to zero, or it might be not even to zero, but find to some point which will be unacceptable loss from perspective of your business. Right. It might cause your investors pull, and it could cause your banks, your vendors to pull your credit lines, whatever, or your boss to fire you, whatever it is for you, the unacceptable loss is you. So you need to manage to that. That's why you do need to have some risk reduction procedures if things start deteriorating. So you will have less, because otherwise, honestly, you always will get wiped out sooner or later. It's just, if you're like aggressive trader by nature, if you don't put risk management procedures in place, you will get wiped out. Sooner or later, you'll be super confident in something and it'll be absolutely wrong. It just happens. So position risk management is a very different thing. When you look at for example, if I do X versus Z, right? And X goes up and Z goes down. Yes, I could have a stop on Z, but then I can make a rational strategic decision. How am I planning to trade Z? Am I going to trade it with a stop or not? And there are many assets that if they go down 40% in value, okay, well, it's just, if there's nothing changed from my perspective about the value of this asset, it's just now even better investment. Why not keep it? Yeah. And why not even possibly add to it if your portfolio risk allows it? Right. So there are some situations where stop are useful because, for example, as I mentioned, some assets tend to trend. And if certain assets started to clearly trend against you, I would, for example, give an example of oil in 2025. I've been long oil, and oil started deferred oil contracts. It was not really a big loss because I was not playing with front oil, and the backwardation was working in my favor. But in 2025, oil just started to trend down. Okay. And eventually I was like, you know what? I don't like the way it's trading. I'm just going to get out of it. Right. It was not because my boss told me you have to cut oil and your portfolio has no risk. It's just because I just didn't like the way it was trading. And maybe in the long run, that actually might prove to be an error, because maybe in 2026, it's going to go up, but it continued to go down in 2025. And if I want to be long oil, I can buy it now cheaper than when I sold it. Right.
There you go.
So, or at least similar to where I don't remember even. I think I can buy it now cheaper than I sold it, or at least I've had chances to buy it cheaper than I sold it. So if I don't do it, it's because I wanted to own something else now, right? But there are times when I want to have that freedom to see, like, I don't like the way something is trading, I'm going to be out of it.
Oh, I completely agree. I always tell people, if you're having any doubts, just get it off the sheets. You can always buy it back or sell it back or whatever. And just your brain, it's clearer once you don't have a position. All right, let's talk a little bit about the book. And what would you say was the biggest surprise in doing this, second edition? What, you went about doing this and you probably had some ideas going into it. What was the thing that shocked you the most?
Well, I think it was interesting to review what I said and said, like, oops, I said this and that's not at all what happened. Or conversely, like, oh, wow, I nailed it.
Yeah.
There were some great moments when I said, for example, there was a moment I say, I really hope next time this happens, I'll nail it. I even said at some point, there is a good question whether next time when this happens, will I be able to nail it? And I could say, this question is answered. I nailed it.
That's always nice.
But the opposite too. So it was kind of interesting to go through this, look at my both predictions and recommendations, and see which one of them are. Especially, it's kind of hilarious with regards to, because I used my methodology to do stock market predictions for some individual stocks in the first book, and I really individual stocks. It's not even part of the mandate. The only reason I ever trade, almost the only reason I trade individual stocks right now is as part of my commodities views. Like I could be trading mines or something. I'm not a stock analyst, right?
Okay.
But I did examples of some stocks just to make it more accessible to public. And it's just interesting how stocks went like totally randomly. This one I was totally right on. This one I was totally wrong on. This one I was right for like 3 months and then totally wrong. It is just like all over the place.
Okay. So we'll finish up with a couple of questions about the markets. What do you think will be the biggest surprise for markets in 2026?
Well, from your reaction, it appears that if rates go to zero, that would be
well, that would be my biggest surprise, because I don't most people would say the terminal rate is 3 or whatever, right? Like nobody has 1 in their cards. Like there was a period when people used to think that, and then it's gotten beaten out of them. So it was just fun to hear again, because I haven't heard it in a long time.
Yes, I think 0 is a very likely outcome. I'm not saying that it's 100% outcome.
Yeah, no, I understand.
I just think it is. When I say that something is very likely, I generally mean that it's disproportionately likely relative to the current probability assigned by the market. It doesn't even mean that it's the most likely. It's just
no. I completely understand. You believe that your assessment of it of that happening is a higher percentage than what the market is assessed it at.
Yes, and if that is correct, that is kind of the surprise I could predict. And I think the other thing that might happen, again, for some reason none of us could understand, when stock market at last decides to correct, right?
Yeah.
But that would be, honestly, if that happens, it probably will happen through some chain of events that none of us can foresee or envision. So like the biggest surprise of 2026 could be a surprise to me.
That's right.
Like
by definition, that's what I always tell people, that by definition, crises are always like a surprise, because if they weren't a surprise, we would have hedged for them, right?
Yes, and they don't happen on schedule. They never happen on a given year, on a given month.
Yeah, that's right. They're never on a schedule. You're absolutely right there. Okay, so we'll end with some fun stuff. Generally, I've been asking, and I didn't prep you for this, so I'm going to put you on the spot. We'll see how you do. I asked them, there's this BBC show called Desert Island, and you have to pick 10 albums, and then like celebrities say what albums they would be left on the desert island. I make one called Trader Island, and in essence what I do is I say, give us your top 3 bands that if you were stuck on a desert island that you'd want to listen to, like music bands, and it could be anything. And then one other is you're allowed to take a trader from history, anybody, like Jesse Livermore, whoever you want, and have him on the island, him or her on the island with you to trade. Who do you pick? So are you up for it? I know I'm putting you on the spot, but you think you could do this?
Well, let me see. With music bands, I'm kind of really handicapped because I have no musical education at all. So I'm probably
Oh, well,
will
what
strike
do you
out
listen to though? Do you listen to anything fun that who would you take? Like if I said to you, you're going on a desert island, what 3 bands would you take?
I'm like listening to like Lord of the Rings music when I listen to music. So
You know what?
just
It's
to
funny
give
you
you
say that. I actually found on one of my blogs or something, someone said, "Oh, I listened to Lord of the Rings to study." And I actually did it when I was writing a post, and I found it very good. So, okay, so we'll take the music off. We'll just go with the trader.
music, I'm just really flanking that question. I'm
Okay,
telling you
no
right.
problem. Well, so obviously, that shows you why I should have prepped beforehand. But I take it on the trader. You have a person in mind.
Well, you know who was the greatest trader in all history? And I'm afraid to veer a little bit out of the range, but Joseph from the Bible.
Oh, really? Why do you feel that way?
Configured the grain squeeze.
Yeah.
Remember, there was like 7 years of really good harvest, and he accumulated grain.
Yeah.
And then when there were lean years, he was just like helped the pharaoh to purchase all the property in Egypt for the grain during the starvation years. That was the greatest commodity speculation in the history. Regardless, I really don't want to like project any religious views or offend anybody religious views, but just as a story, that was the greatest commodities trade in the history of humanity, the grain squeeze engineered by Joseph.
I love it. That's a take we've never heard
also
before.
He had like a line to divine
That's right.
prophecy through sleep. I was like, I can run with that.
I got it. All right. Okay. So I'll just repeat here for those that are want to read the book, and you should. It's the where are we here? The Next Perfect Trade: A Magic Sword of Necessity. Again, it is the 2nd edition, and the 2nd edition will not be out till Tuesday, January 27th. So do not go buy the 1st edition. It is the 2nd edition, and it is vastly different than the 1st edition. Alex, is there anywhere else that you want to send people? Like, do you have a blog or Twitter or something you want to promote?
Well, thanks. Well, I have an X account, and I could be pretty easily found on X. Just it's
Okay.
Gurevich23, but just if you just use my name, you'll find me. And then another way is just to go to my company's website, honte.inv. Now it's important that it's we only to get inside and get any like investor information, you have to be a qualified purchaser. So I'm not advertising that. I am only talking, but there is stuff on the website with my publicly accessible blogs and certain articles that I've written over years. So if people want to, and books, if people wanted that kind of public access portion of my company, they're welcome to go there and check it out.
Great. Alex, it's great to see you again. Thank you for making time for us today.
All right. Thank you very much.
So joining me for talking charts is Pinecomb Macros, Chase Taylor. Chase, you're a great friend of the show, and thanks for pinch hitting for Kevin, who needed a day off. And you know, I can't think of someone more interesting to talk the charts, because there's some crazy ass shit going on, and I'd love to get your take on so much of this. And so let's just dive into it. Let's get in there and talk some charts. Starting off here, let's talk this S&P. Obviously, the tariff tweet comes out, and we start on a long weekend with markets gapping down, but conveniently Davos is a day later, with Trump meeting all the people he's threatening to tariff. It was like if there was ever going to be a taco event, it's the fact that you know, Davos was right there, and we got the down day and the reversal right in there. We're going to look deeper together at what's making this market up, but like, how do you size this up? This market is a little bit heavy. Are you still leaning in the bull trend, or are you starting to lighten up here? What's your take on the broader market?
Yeah, this probably sounds weird, but the funny thing about the S&P for me now is I just don't care. Like it's boring. Like you said, there's crazy shit going on, and in the S&P, I mean, all the indexes really in the US just they're not it. Like they're just not doing anything. They can't break down. They can't break out. To me, it's just boring. There's so many better opportunities. I had a tweet out yesterday showing all the ex-US stuff just blowing the US out of the water. As of yesterday, out of the 45 country ETFs, only I think 3 or 4 are doing worse than the US. So it's just
Yeah.
what's the point? Like all of a sudden, you know?
So it's interesting here because let's just highlight a couple of things. Number one, the breadth of the market's been improving since December. So after that little November event, we've gotten back to about 70% of stocks participating, which has allowed things like the S&P equal weight index to actually do relatively well. You can see there's an underpinning sector rotation going on in this market. And while the equal weight index is rising, there's been some rock and roll advances in the small cap space that's doing well, but it's all at the expense of the Mag 7s. So the Mag 7s, got to the stage of literally being 1/3 of the S&P 500 market cap weighted index, 2/3 of the Nasdaq 100, and so without these stocks participating, the analogy I keep giving is it's like throwing an anchor off the side of your boat and asking why you can't go full speed. And so this is probably the drag. And so the question I have for you is, what's your take on the Mag 7s? Like, we got earnings next week, and it's like the pig in the python moment of where they're all going to report within 24 hours of each other. What's your pulse? Do you have a bias that you think they're going to beat or something, or where you stand on this?
Yeah, I mean, I think they'll probably do fine. And for the last few years, really, for me personally, the only one I've liked is Google. That honestly pretty much holds for me. Like, still the only one I like, and I like it less because it's done so well lately. But
Yeah,
the funny thing is, like you mentioned, like the Russell's been awesome so far this year. But the funny thing is, like, the Russell is worth like $1 trillion less than just Nvidia. So like all this little stuff can do whatever it wants, and the S&P just like shrugs its shoulders, you know? So I'm assuming they'll do fine. To me, like the big thing is like the CapEx side, and if AI is making any money yet, like I think that's what people are going to key in on.
Right. So here is a chart of Nvidia, and there's no shortage of people on X or any of these other platforms that are trying to call a head and shoulders formation developing on Nvidia. Well, in fairness, the one thing that I kind of am observing is Nvidia, which is like 1/5 of the market cap weighting of the SMH Semiconductor Index. You have the Kospi ripping higher, the Nikkei ripping higher, the Semiconductor Index ripping higher, and Nvidia not even getting an uptick. Like you're seeing that it just never participated whatsoever in this advance. And so, with the fact that we've seen such big advances in semiconductors and in the Kospi and stuff, what's your feeling on Nvidia? Do you think that Nvidia's topping out here?
I mean, it's very possible. Like, but I will say, I do remember the last time I highlighted a head and shoulders on Nvidia, and that was probably 250% ago. So it kind of reminds me of just the S&P on the chart, though. It just looks like it can't go up or down. Like, it clearly, you've built a structure that if you break below, it looks terrible. But at the same time, like if you have a 5% up day after earnings, the chart all of a sudden looks really good. So,
well, the one thing about Nvidia. The one thing about Nvidia is earnings are going to get punched out all the way to the end of February, right? So we've got more than a month still before we're going to hear from Nvidia, and I think that there's going to be some clarity on these markets long before Nvidia's reporting, and so we'll see whether that plays out. The one thing I want to touch on though is this Kospi, because Kospi has been the hottest kind of AI way to play this. Obviously, Samsung and Hynix, SK Hynix, are rocking and rolling. They've become, like, I remember back, like, just to show my age, but like I remember back when Nortel in Canada was, made up with BCE 30+% of the Canadian market capitalization. It was just like the index was there. And here, I think that the two stocks make up like 40% the Kospi, like the concentration. Like this is just a real play on those two stocks, and they have been on fire. Like this is where everyone's been playing this on the upside. Like, what's your take here? Is this something that can still sustain?
I mean, obviously, I think it can. The memory side and the chip side, like they have a lot going for them. But for me, that concentration is just, it's too much risk. Like I wrote a lot about South Korea last year. I was super bullish. Wrote it pretty well. Although I for me, I like their KDEF ETF more than anything because it had a lot of shipbuilders and defense contractors and stuff. That was what I really wanted. But even that stuff went straight up. So like,
Yeah.
For me, everything Korea now is too high and too concentrated. Like you mentioned, Kospi super concentrated. If you go to the ETF, the EWY, like it's like 45% in those two names.
Yeah.
And like 30% like is too much, but like whatever, I can hold my nose, but half almost, like now I'm just subjected to a drawdown and a couple
Those
names
two
tied to
stocks
AI,
drawing
just no
down.
thanks, right?
Absolutely. I couldn't agree more, but like this has been what's been driving that, right? Like, but the fact is that semiconductor index, in spite of 20% of this SMH being NVIDIA, it's been one of the stronger markets here, right? Like everything from financials are lagging, and a number of these different sectors dragging. It's like even with NVIDIA not participating, the semiconductor is still getting a lot of love, and you can really see that investors still are not done with the AI story yet. And the thing, but now, is it? What do you have a broader market call like that? We enter some prolonged kind of AI correction phase where this kind of bubble will burst inevitably. And do you think it's like a story for this year?
I think what the market shows us now is kind of what I expect to continue. Like you have some AI and AI adjacent stuff doing great, like Tower Semiconductor. Like there's some names out there that are doing great, but then you look over at something like Oracle, and it looks terrible. So like I think we're going to continue that where people that are taking out too much debt and doing too much capex, and having too much of their future earnings tied to the success of just like basically open AI. Like I think some of that stuff will struggle mightily, and the bubble, I would argue, is already burst in something like that company. But then you look over and there's a lot of the picks and shovels ex NVIDIA that are still doing well, but it's also going to keep evolving. Like the new NVIDIA chips really talked about like how the cooling needs are like way less. So you see all the companies that have gone parabolic on cooling needs like get smashed just on that one little comment. And it's like, as the tech evolves, you're going to keep seeing that. So I think it's going to be a bunch of stuff winning and a bunch of stuff losing in the space. So honestly, alpha and the AI trade is going to be the nerds that are staying ahead of those like real life fundamentals. And that is not going to be me.
Well, the part that I always look for the canary in the coal mine, like of when we're going to enter some sort of market correction. I don't have a chart up on it, but like we haven't seen credit spreads or junk bonds start to crack, or a lot of those kind of areas that typically would be warning signs. But we had pretty clear gap downs on financials on their earnings. JP Morgan, Bank of America, Citi, Wells Fargo, you name it, they all negatively reacted on their earnings. And you see the XLF here, the financial ETF, clearly break below its 50-day moving average. And this is your quintessential beta 1 asset that like basically is supposed to be going lockstep with the S&P 500. And to me, I in order for me to feel comfortable making a call that the S&P is heading to 7,100 or higher, to me, the financials should be just lockstep working with this. If we see, in my opinion, the financials continue to distribute, I'm looking at it like a warning sign that the market's just not healthy. Do you have a different take on that, or is that kind of align with your thoughts?
No, I think that makes sense. I think, that the talk of making them cap credit card rates and stuff doesn't help either. That would be very bad for their earnings, their margins, you name it, and the economy, which is bad for banks, obviously. I think it's sort of a underlying thing here that a lot of people aren't talking about is like the global economy and the U.S. economy are really starting to pick up, and I think you can argue that that might not be great for them, even though that sounds weird. But
Absolutely. Absolutely. So let's go through these global indices. I'm going to just start off here with the Nikkei. But like the Nikkei has not been as hot as the Kospi, but it's been structurally bullish. Obviously, a weak yen has a tailwind, but making higher highs, old dips being bought, not violating a 50-day moving average. Like overall, the Nikkei's been behaving well. But Japan has been a stress point with JGB markets under a lot of stress, and even a move in the yen today, which we can talk about when we get to currencies in a moment. But are you generally bullish the Nikkei here?
I am. I like Japan a lot, but if you look over the last year, 2 years, like it's done well, but then you compare it to a lot of other countries. I mean, you can almost throw a dart at something in Europe or whatever, and it's probably beating Japan. Like it's kind of middle of the pack, maybe even a little worse. And I think you're kind of still there. I still think it's possible that they bring a lot of money home someday, and it can become really nice like bubble again in Japan. But so far, it's just kind of been a boring grind higher.
Right. Now, one market that was quite boring for almost all of last year was the Euro stock, which was just trading sideways. But obviously, all of this defense spending and other stories started coming light. But it is definitely, maybe I would argue, more boring than the Nikkei. On that, some individual European countries certainly have been rocking and rolling.
Yeah.
But at least as a broad Euro stock, it's been a laggard. But generally, higher highs, higher lows, finding support at 50-day, it's been working well. I mean, would you stay bullish Europe here at this stage?
Yes, but I think that the country picking part of it definitely matters whenever it comes to Europe. That, like as you pointed out, like these 50 have been, pretty boring. But you look at something like Austria or something like EWO, just a beast. Like, and there's a lot of these names that have been,
the Polish markets and all.
Yeah,
they've all been running in a big way. But what is interesting to me is when we go to look at the China A50, and while there's been an uptrend as the all emerging markets were generally doing well, what we're clearly seeing is the China market under a little more stress, and even the India market under a lot more stress than a lot of the other emerging markets. Have you been watching this, and what's in your mind on what could be causing this here? I'll just quickly show how the Sensex in the Bombay market has been really also under a little bit of stress. What are your thoughts here?
Yeah, India's been terrible. It was one of the worst performers last year. It's one of the worst performers so far this year. I'm super bullish China, and really medium long term, as much as short term. If you look at like CQQQ, like that chart has been very solid in my opinion. So same with China, where you got to be in the right place to get the move. But I think you have seen some weakness lately, and a lot of it comes out of policy. Like they want the market up, but every time it has these like 4% up days or like 10%, over 2 weeks, they come in and find a way to kind of put their foot on it to make sure it slows down. So like they beefed up margins where you got to be basically 100%. Like you can't be levered up, stuff like that. Like everyone likes to highlight the national team whenever they're buying equities. People forget to highlight when they sell it back. So you've had some of that at times where they're selling back into these rips. They want it up, but I think they want it to go up at a measured pace, which makes sense, because if not, China has some crazy blow off, moves in the past that they obviously want to avoid. But I'm incredibly bullish China.
So What I want to move on to is let's touch on Latin America and South American markets, and what we can see here is Brazil just rocketed like this. The Ibovitsa is just like on fire here. Like not only was the consolidation and election worries like brushed off within weeks, but this thing is just gone full parabolic. Obviously, heavily resource driven. So all your valets and stuff like that are ripping. But even Mexico, this is the EWW breaking to new highs. And look at the way Argentina broke out of a multi-month trade range like it's ready to go. What's your thoughts here on these Latin American, South American markets?
Yeah, they've definitely been the leaders so far this year. Peru and Colombia and Chile have been kind of the three leaders of all of them. But you can kind of see the rest starting to come with it. I mean, you look at like the real, like the chart. I mean, it's breaking out in a big way versus the dollar, and that's super helpful for Brazil. That's like always the worry because they have a giant deficit and stuff that the currency could become a problem. But hey, if you run a giant deficit, but you also have really high real rates, like you can get away with it for a while. So all this stuff looks great, and if you think about it, all of it's tied to commodities and metals. And if you're Peru or Chile, you kind of overlay the chart on top of copper, and it's like, oh yeah, well, it's about the same chart, and that makes sense. Kind of like South Africa and platinum, palladium. Like, oh, there you go.
Yeah. Well, so listen, let's use this as a segue to talk currencies because there's some serious action going on here. I was looking at the dollar even just earlier in the week as still being in a very neutral, quiet zone, but really in the last few days, the dollar has really woken up. And so really we had the first half of last year a pretty decisive bear market in that U.S. dollar, and we went through a pause, a consolidation, often retracements, fibs, whatever you want to measure it out at, with a consolidation period. There was even room for the dollar index to spend some time above 100 temporarily in the reversion, but after a failed rally that couldn't even clear 100 here, we're now attempting to make a lower low. And on the surface, that's, well, let's actually pump it to a weekly chart and really zoom out here, because it's important to highlight that this entire consolidation of 2025 was materially under the lows of the last few years. And there's that old adage we have in technical analysis where previous supports become overhead resistance, right? And so the dollar's already been in a structurally vulnerable spot all year with this breakdown. But you see this weekly breakdown candle that's happening here. It begs the question as to whether the floodgate on another US dollar decline is imminent. Like, we've literally rejected that 50-week moving average repetitively. And it's like that structural downtrend seems to very much be in place here. Now we'll look at some of the individual currency pairings, but how do you size up the dollar market here?
Yeah, this move, especially today, is one I didn't see coming. Excuse me. We kind of went from looking almost like a rounding bottom the last few months to looking like it was just a bear flag, which is very notable. And I think, obviously all the Greenland back and forth, all of a sudden, next thing you knew, you had, a couple pension funds in Europe talking about like, yeah, we're going to get rid of some treasuries. You had Australia talking about like, we're lightening up on the dollar like assets we hold. Like, so you're starting to see some of the rest of the world thinking more and harder about getting out some assets out of the U.S. because the rest of the world has over, I think, 20 trillion more invested here than the U.S. has invested abroad, and that means it doesn't take much for U.S. assets to have a bad time if foreigners just take a little bit of money out. So I was definitely tactically worried about a move higher. just even a few days ago. But now all of a sudden it looks like, yeah, the kind of longer term down is there.
That's in a complete, I'm in complete agreement, right? Like, and what I look for is when there could be a potential emotional kind of pivot where most traders were caught off guard, not expecting something to happen, is when the reaction function becomes that much more, like the volatility and the liquidity can pivot the most in those kind of periods. And this is why we want to pay attention. Like, look at the way the euro working back to its 52-week highs on the upside. Look at the pound sterling broke to a higher high, going for a retest of those levels. And another huge one was the Aussie dollar, like just massively cleared.
Trailer.
Like just took off parabolic, like if it's a silver chart or something. Like just like the Kiwi got blasted off on the upside. Even the Canadian dollar. I'm going to look at the CAD US. You can see the Canadian dollar rising against the US dollar here, and so you're basically seeing that almost all the currencies are lining up. But the one that I think is the most important one to watch is what's happening on that yen. I'm just going to look at the yen futures here. And now, because I want to look at the yen chart as opposed to US dollar against the yen. And the yen has been in a bear market all since the second quarter, right? Yep. And a clear downtrend. But look at today's reversal candle. After retesting that low, I mean, do you want to count it as a double bottom when it's only 5 days apart? Is what technicians can debate till they're blue in the face. But the bottom line is like you got a very clear reversal, and now we're going to test a direct 50-day moving average. Like, if we see the yen join the party, then you have literally all the currencies rallying against the US dollar simultaneously. And that's when I pay attention. Like if you got a couple of them going up and a couple going down and there's a mishmash, then, the trade range is likely the most prevailing outcome. But when all the currencies are all lining up for a bull move against a weakening US dollar, that's when I pay attention. And the fact that the yen made this reversal means that it's potentially in play. And if we see this, obviously one day doesn't make a new trend, but if we see this actually get built upon in the next little bit, then this becomes something we can't ignore. How do you size up all of these currencies, and which one do you want to look at?
I mean, you went through a lot of them, and the funny thing is I'm short like 6 or 7 different things versus the dollar. Mostly it's like I don't know which one's going to really win. I think my favorite at the moment might be the loonie, but like Polish zloty, I like. I mean, there's a lot in kind of Northern Europe that I like. It's hard to pick. It's hard to pick the wrong one right now. I did feel strong about the Australian dollar because I think the liquidity cycle in China can, it just kind of naturally spills over there quicker. And obviously, I like the Aussie and the loonie both because of the commodity currency aspect and because the commodities are doing pretty decent at the moment. But to go to yen real quick, like I find the yen super fascinating from a macro standpoint right now because you sort of have like a debate on whether or not they're in total, fiscal dominance where the interest costs become such a problem that everything has to go down, or if they're outside of that, it should honestly be rallying with the rates going up and all this stuff. And then sort of as a side note, I have this weird view that if Japan goes out of its way to QE up their bond market again because the yields are getting unruly, or they shove bonds down the throats of their pensions or banks or whatever, they do something to cap yields. Like typically people view that as very currency negative. I have this view that if they went out and QE'd up 10% of their bond market tomorrow, that the yen would actually rally on it. Like, so there's nothing more interesting maybe than macro right now than how the yen handles where they're at. I mean, their debt to GDP is actually falling lately because their nominal growth has been good. So in that sense, you should look at that and be like, well, they're not really in fiscal dominance. But then again, like, their inflation and their rates keep going and they don't care. So they're going to do more fiscal. And it's fun whenever you can make a really solid argument in two different directions to watch how something plays out. And I think that's where the yen is.
Yeah, it's and I think it's the marginal player here that will decide what the trend of that dollar is, because like if it goes like, and you were earlier mentioning the Brazilian real, and you basically have this currency working higher. Like, is this going to be where they finally have another leg up on the upside? Is another one to watch, right? Like, just it's right now. I mean, in the end, the U.S. dollar weakness is what at least the administration has advertised as they want, and it really seems that they're getting it. And the interesting part, and we'll use it as a segue to kind of discuss, like, well, the one outlet that is a huge benefactor of U.S. dollar weakness is the commodity markets, and the big winner, at least in the last little bit, has to be the precious metals market. And let's go through the four precious metals and like highlight what is going on here. Let's start off with the big one, in gold. And here we have, like, gold futures today had a high of 989, like $11 away from a 5,000 print. So here we have a scenario where gold has, I've been talking about this 5,000 target, but now what? Like, in the end, this thing has gone full on parabolic. I was talking $100 silver, and we're at 101. What do I do? Pull a Goldman Sachs and just raise my target? Like, like, in the end, a lot of these were my targets for the year, and they're being achieved in January. And like, first of all, how do you size up these precious metals markets, and what's your path that you think? It's easy to make a long-term bull argument, but the question is like, what's your pulse or your feeling on how things could play out on the short to interim period?
Yeah. I mean, obviously, when you're in a parabola like this, it can keep going up. It could be 150 in 2 weeks or something. Who knows, right? But for me, like, as a trader, looking at risk reward, like, I especially am petrified by silver at this point. I've taken two little shots at shorts along the way that, just paper cuts stops, and I'll do it again and again, probably. Like, I think silver badly needed to re-rate higher. I wrote a very bullish piece about it like 2 years ago, and how solar demand was, if it combined with investment demand, was going to create a bona fide squeeze, the kind of squeeze all the dumb people on Reddit or whatever kept calling for every year. Like, that we could actually get that. Well, obviously we're actually getting that, but I didn't think we'd get it to 100. I think the fundamentals back up a lot of this, but not all of this. I think, the last leg of this is just too much. It's a lot of speculation. It's a lot of, force buying, kind of, in nonsensical stuff. But one of the points that a lot of people make is it's just so hard to get a response from miners. Like, they can't give you more metal in any short time frame. But people like me can. Like, I've been stacking physical silver for, the last 15 years, and I'm literally going to go sell some this weekend for the first time in my life. Like, and there's no way I'm the only person that's willing to, cash in here. There's a lot of silver that's going to start getting recycled. The solar producers are going to start moving to copper. Like, the demand destruction will be real, and the supply diversification will be real. Like, so do I want to buy it here? I do not. Now, if it goes back to $55 or whatever, like, yeah, like, time to party again. But up here, it scares me if I'm long, for sure. If anyone is long and not expecting to have to eat, a drawdown of at least 30, if not 40, 50, I think you're going to be welcomed to how commodity markets work before
Yeah.
long, but it may be after
Well,
it goes to 150 because that's a parabola.
It's interesting because like I'm still actually Delta long silver, but back around $80 when we had some really deep in the money calls we were riding that were very close to Delta one, so we were synthetically long the thing like almost like it's equity, but been basically resetting my risk reward by converting it now to just bull call spreads out of the money. So I've been participating with a much more smaller outlay, and so basically a risk that when it reverts, you're only out a small amount of capital. All the meat on the bone has already been profit taken, and so it's I'm not short, but definitely not going to get hurt when this thing finally turns around. But what a move! But overall, like what's your take here though? Like gold at 5,000. I mean, look, anyone can go out there and say, "Oh, gold will be by the end of the decade 7 or 10,000," and they'll probably be right, right? So we're as technicians here talking about the short-term path in here. But is this also in your mind getting a little overextended on the short term?
Yeah, I think gold's also, too high, overbought, all that. But I think gold has way more underpinnings, kind of like called medium term than silver does. I mean, if central banks want to keep buying it, then it's just going to keep going up. It's a little different from some of these other metals that have more industrial side that can dominate, the supply and demand angle. So I think gold's going to be better off, here medium term. But this is the way precious metals bull markets work. You get gold going, and then silver goes, and then you start getting some of the other stuff participating. I would feel way more comfortable being in gold over the next 6 months than silver from like the drawdown risk. I think it's going to have a drawdown, but it's not going to be one that just wrecks some people the way I think silver could.
What worries me about gold is that story is such a convincing one. Central banks are buying, it can't go down. And what reconfirmed that was that literally every correction in the last 2 years that we've had in gold was sideways instead of down, right? Like it was all these horizontal triangle consolidations, which basically means that everyone has been rewarded for remaining highly levered up in gold, and a psychological reinforcement that like it can't hurt you. And I find that when you become convinced of something to be absolutely true is when the market has the best chance of separating you from your money. And the fact that is just such a consensus view that it just makes me like, what could go wrong? I don't know. I'm not going to predict that gold's going back to 4,000 or something stupid, but it just bugs me that everyone is so convinced that it can't hurt you. It's like, I hate being in a consensus like that when that becomes the prevailing thought. And this is where, like, I reminds me of like the uranium story. Like uranium was so bullish, but back, like I'm just gonna like go back to, let's say, URA, but like there was that time where no matter how bullish uranium was, and the story was great, back in 2024 and early 2025, there were 30-40% haircuts, even though the primary long-term bull market was quite intact.
Right. And, there was a lot of great news in those pullbacks. Yeah.
And so like, I don't know, like, is there one big gold margin call coming? We'll see.
One thing I will say about the risk side of it is if you chart it against like global money supply, which I think is a fair way to think about gold, obviously, like it just went nuts. So like even versus global money supply, it just went nuts. So like obviously central bank demand is so big and there's just not that much gold that as long as that bid stays there, it stays there. But there's nothing, it's not a law that says that they won't take a break from buying. And if they take a break from buying, it would feel it, not to mention there are so many people in it now that would have to puke along the way lower. Right. So like, it's just, you you're right to think of the risk side of this. Like anything that's going straight up and no one can think of a reason it could go down, nothing could be more risky than that.
Like the price is always discovered by the marginal buyer or seller. And when one is convinced that you can't lose money, the only logical thing is to be fully margined. And the amount of money people are making on being fully margined is like a positive feedback loop that has them consistently leaning into this thing over and over again. And inevitably, that margin situation and the highly leveraged becomes the marginal seller. And this is where a lot of people listening to this, oh, you guys are just idiots. There's no way like that. Gold is it's a new global regime and the world is dynamically changing. But the thing is, the one thing that hasn't changed is the nature of liquidity and market and live auction pricing that happens in the market. And dynamics such as margin are huge players on the field that will drive flows. I mean, every CTA is loaded up on this max long. Every so systematic strategies are long.
Right.
Like there's going to be a point where it's just going to trigger a negative feedback loop that is going to drive a correction, right? And you know what? It'll just be an amazing buying opportunity. It's not about being bearish gold. It's just the fact that you have to expect some sort of volatility. And I'm going to stop ranting. Let's talk about platinum and palladium. Because platinum and palladium is just doing the same shit, right? Like platinum, look at it rock and rolling, almost like it wants to tap 3,000 tomorrow. It's just full-on parabolic rise. And then the palladium just broke to a fresh new high once again, looking like 2,100 is going to happen tomorrow. I mean, is your feeling that they're all going to probably correct at once?
Yeah, probably. Like, I mean, I turned into a mega bull on platinum palladium in May of 24. And it's funny, I posted a thing about this yesterday, but I did this and I didn't realize it at the time, but I did it. I bought this literally the same month that JP Morgan had downgraded Sibanye-Stillwater, one of the equities.
Yeah.
And guess what they did yesterday? They upgraded it. Now that it's up 300% and up into a new high, they're like, well, we're going to upgrade this bad boy. And then HSBC followed suit. Impala's getting upgraded.
Yeah.
So like for me, it's like, well, I'm good. Like I literally sold today. We hit a new all-time high. Like that's good enough for me. Like it can double from here. It might double in 3 months or something, right? Like this is the way
when you made
going,
this kind of stupid money, you have to at some point.
The risk reward is just changed, and
yeah.
And for me, my fundamental thesis I had has basically played itself out, and in my own internal fair value of where a lot of this stuff should be. It's like actually we're probably overshooting it now. Like from a pure demand for these metals outside of speculative investment demand. The real demand that comes from vehicles and stuff, like I don't think it's this high. So I love platinum long term, but yeah, same as I love gold and silver long term, but this is too much for me.
Yeah. All right. So let's talk crude oil. All right. So listen, here's my thesis, and you can shit on it. Like, you can tell me whether you agree or disagree. But like, for me, something happened at the start of the year where bad news after bad news keeps coming out on crude oil. It goes down for a day and it's bought on dip. And nothing gets me more interested when there's bad news and the asset stops going down on bad news. And for some reason, everything, like the story is so bearish on oil, and oil just don't go down. It's like the honey badger all of a sudden, like it just like it's being resilient. To me, when everyone hates it, no one cares, nobody's interested, and there is no bullish thesis to be made, but yet the price is telling you some type of flows have pivoted. I like to pay attention to these stories. What's your take here?
My take is literally exactly the same as yours. So I mean, last summer, spring, late spring, OPEC comes out and they're like, like no one needs more oil, and they're like, but we're going to give it to you anyway. Like it would have been crazy not to get bearish at that point. Like oil was already cheap. We weren't in a shortage, and they're like, cool, you guys want some more? So I was bearish until literally we broke that 50-day, and I was like, because the same thing, like no one likes it. I can't make a bull case. I literally can't. Like the supply and demand sucks for the next few months. But here it is above the 50-day, and it's like, but it's probably just Iran risk. We get a little higher. Next thing you know, like, well, we're not going to bomb Iran, and it can't really go back down that much. Like the 50-day held, despite the fact that some of that geopolitical risk got pulled out, and here we are. We're not that far from testing that Iran high. Now, the Iran risk is coming back into the market because the U.S. is moving assets into the region. So, like, don't get me wrong. Like, there's still plenty of Iran risk in the price, but I'm in the same camp. Like, the chart looks good all of a sudden. Positioning, like, no one likes it. Sentiment, no one likes it. I'm sure some people saw,
all you need
like,
is one Iran headline, and this and like the CTAs will have to flip, and you're going to have all sorts of a pivot in the flows, and then it becomes a positive feedback loop that just basically feeds on itself, right?
That could rip you to 70 for no reason other than you have to unwind so many of the forces you got here.
Okay, well, we can't go to any further commodity without touching on the Widowmaker. Like, what the hell? Like, okay, I'm gonna make an admission to you, Chase. Like, I ate it on nat gas this year. Like, I got so bullish back in the third quarter of last year, and I was riding it, almost bragging about how much money I'm making on nat gas. And this thing gave me a punch to the solar plex like nobody's business. And that's
what it does.
Exactly. That's why it's called the Widowmaker. And then like if I could get one position so spectacularly wrong, it's this one. And I cut the losses out of the position. And then in 3 days, this thing is right back up to the highs. And I've just got egg all over my face. Like, I could not have screwed this one up any more worse. Like, I got so many things right in the last year, but this is not the one. Like, this is the thing that just but like, how do you size this up, and what's your thoughts here?
Yep. So I've been a nat gas bull forever, and that's cost me at times, and it's made me a bunch of money at times. When it came to this, I did a good job in futures of navigating this, but I did the same thing. Virtually, I have like a 10 by 10 ETF portfolio, 10 ETFs, 10% each. And I totally round tripped the nat gas ETF all the way up and then all the way down. And the same, I may have bottom ticked it even worse than you on getting out of that. And it's so dumb because, like, I was smart enough to get back into futures whenever it got that down there. But for some reason, like, I could not put that nat gas ETF back in. So here we are, like, that destroyed the performance of that model portfolio. And where we're at today, like, I'm literally in a battle with myself. I have May futures of whether and some crazy May calls for $7, but I'm just in a battle on whether or not to let the May futures go here or keep riding it. And for people that don't know, like, this was all totally justified by the weather. Like, December was brutally warm, and then now we have insane cold. So this is just how it works in the winter. Like, weather models shift that bad. This is what happens.
No, it's unbelievable. Like, I can see the argument long term, and like, this is the UNL, which is
was the one I bungled.
Yeah. But like, you go on a weekly. I mean, it's not like this thing can't still have lots of upside, but what a vicious cycle on this. Anyway, let's touch on uranium. I'm going to use the very illiquid uranium futures on a line chart here to just get a pulse on like what's happening. But generally, uranium has finally started to work its way higher. And while I don't trade the futures, it's nice to kind of get a pulse on the trend. But clearly, there's been a uranium bull market in the equities for a while, but it's like it really feels like the last 3, 4, 5 months that that uranium as an actual commodity has finally started to join that party. How do you size up the uranium markets, and you think that this is the new bull market here, and where does it go?
Yeah, I'll start by saying I've been a uranium perma bull for literally a decade now. It started for me in 2016. So I'm not a casual observer. I have an opinion at all times, but I love uranium. I still do. I still don't think it's anywhere close to being, at fair value. But I will say, when you look at like URNM, like it's gone straight up here the last few weeks, and so that it makes me a little nervous that it might be getting a little bit ahead of the skis. I haven't gotten rid of it yet in that like model portfolio, but I felt better about it buying it when it was in a bit of a drawdown than I do now after it's gone straight up. But
Yeah.
even at like $100, that's not enough to get enough production that you're going to need. So I really think you no doubt go to 200 without a problem before this cycle like becomes, defeats itself.
Yeah.
But there's going to be more pullbacks along the way. I thought we would get a pullback. I didn't think we'd get a pullback as big and as long as the one we just got. So I don't know. That's why it's been a decade journey for me. I'm just going to be in there and be long until we get to like 200, and then I'm going to move on. I sold some at 100 the first time we hit it because it was like, all right, well, you got to take something off. But
there you go. So listen, Chase, we don't have that much time I want to keep it a little more tight. I wanted to talk rates markets, but really there isn't that much crazy shit going on in the rates market unless you're looking at the JGBs. But it's been quiet on the US front on that way. So I'd rather do is I want to put you on the spot and ask for 3 charts that I forgot to mention that you think are interesting that you want to talk about. So is there something that I didn't ask you about or that you want to talk about?
So I'll go to a space that I like, and you can usually find me in the dumpster looking for stuff. So pull up Dow, just DOW. The chemical space is what is something that really has my attention right now. I feel like you're trying to bottom. No one likes this stuff. If you look at like earnings expectations and what the analysts are saying, like no one likes it. And there are some potential like catalysts from the fundamental side. So this is something I like. And there's a bunch of different ones, you could go CC is another one that I've been following closely as my attention.
Sorry, so what was the symbol CC?
Yeah, it's Chemours. I don't know why it's not showing up there.
Okay. Well, what's another one was a HUN, like the Huntsman. It pretty much looks like the same chart. Like they're all the same kind of thing. They've all gone through like a 70% wipeout and just starting to roll up. I'm with you, bud. I've been looking at these two. Great minds think alike. What else? What else is on your mind?
All right, pull up another Siegel name. I usually don't do Siegel name stuff, but a company that I like is Rivian, RIVN. The company I did not expect to like, but here we are. We kind of had a nice breakout of a long base. Pull up a weekly on this one would help probably.
Oh yeah.
Yeah. So this is my favorite chart pattern is it died and then it went sideways for years and no one noticed. Yeah. I actually like their fundamentals. That it was an absurd IPO, crazy valuation. They weren't even making money, but now all of a sudden, like they're selling a good bit of cars. They're coming out with a new model. They're building a new plant. They're going from wildly unprofitable to only a little unprofitable. Like I actually like the company. So this is one that I'm kind of willing to bag hold for a few years because I actually like where it's heading. And I liked the breakout. Now you're kind of back under that breakout area, which is unfortunate, but I think this is one I like to keep going.
Yeah.
And let's see, let me think of one more maybe that kind of fits this mold. Zillow, or no, not Zillow, but Zoom, ZM. Fits the same chart pattern. This kind of like died and
dead for years.
Yeah. I just love these, and this is another one that I like. And you can see that kind of like 90 area. You get above that, it starts looking really, really good.
Yeah. Well, listen, those are all great ideas. I love it. And Chase, we don't do this enough. I'm going to tell Kev to take a week off every couple of months so that we can pick your brain. I love talking to a fellow chartist, and we always love just kind of confirmation bias between the two.
Yeah, there was a lot of that today. Sometimes I could disagree with you. Today I was like, yo, that's exactly how I feel.
No, that's, there you go. The charts don't lie. That's the problem there.
That's right.
But listen, Chase, why don't you take an opportunity to just give yourself a little plug? Where can people follow you, find you, invest with you? Give us a rundown.
Yep. So for obviously, like most people, the easy place is Twitter. It's at Pinecone Macro. My personal website is pineconemacro.com. And that kind of leads to I write a bunch of different stuff, and you can all find it all there. And then from the investment standpoint, I work at Bulwark Capital as the head of research, and that's bulwarkcapitalmanagement.com.
Awesome. All right. Well, Chase, thank you so much for joining us, buddy. And look forward to doing it again with you. Cheers, buddy.
Yes. Looking forward to it. Cheers.